You keep hearing that you should wait for the housing bubble to pop, that you should just hold on for some dramatic 2008 style crash that will finally bring prices back down to earth. That's a mistake. The housing crash isn't coming. It's already here. It's just happening in a way that is much quieter, much slower, and frankly, far more dangerous than you think. For years, we've been watching headlines scream about record high home prices, and we're told it's a sign of a booming, robust market. But that's not the right way to look at it at all. Those record prices aren't a sign of strength, they are the ultimate red flag. They're the final symptom of a disease that has been eating away at the foundation of our economy for decades. Forget the idea of a bubble popping. The real disaster is a slow burn, a silent crash that isn't defined by prices falling off a cliff, but by the complete and utter separation of home prices from the wages of the people who are supposed to buy them. For years, the gap between what the average person earns and what a house costs has been stretching to its breaking point, and now it has finally snapped. Most economists will call this a frozen market or an affordability crisis, but let's call it what it feels like: a silent crash that has fundamentally broken the social contract for a generation. In this video, we'll show you the evidence hiding in plain sight. We'll walk you through exactly how we got here, and we'll reveal what the mainstream headlines keep missing. This is the story of the housing market collapse that everyone is ignoring because they're looking for a loud explosion, not a slow, suffocating freeze. To really get what's happening, you have to look past the noisy month to month price changes and focus on one single devastating chart, the one showing how home prices and household incomes have gone their separate ways. For decades, the relationship was predictable. As wages went up, home prices went up, they moved together. It was a simple, understandable path to the middle class. But starting around the year 2000, that relationship started to fray. And in the last 10 years, it has been completely obliterated. Let's put this in perspective. Back in the 80s and 90s, the national median home price was usually about 3.5 times the median household income. A classic rule of thumb was that your home shouldn't cost more than 3 times what you make in a year. It was a simple test for a healthy market. If you earned $50,000 a year, a $150,000 home was within reach. Fast forward to today, in late 2025, that ratio has exploded. The national median home price has soared to a level that is now approaching 5 times the median household income, nearly matching the most extreme peaks in American history. So, what does that actually mean? It means the median price for a US home, which was about $83,000 in 1985, is now sitting at staggering highs. Meanwhile, incomes, while they have grown, have been left in the dust. Since the year 2000, median home prices have jumped 177%, while median household income has only grown by 92%. And when you adjust for inflation, it's even worse. Since 2000, real household incomes have crept up by just over 8%, while real home prices have surged by more than 56%. This isn't a gap, it's a chasm. It's a fundamental decoupling of the value of your work from the cost of your shelter. The result of this chasm is a market that, for most people, is now a spectator sport. According to a recent analysis by the National Association of Home Builders, a mind boggling 75% of all US households cannot afford a median price new home in 2025. Let that sink in. Three-quarters of the country is locked out. And this isn't just a problem for low income families. We're talking about over 100 million households, including essential professionals like teachers and nurses. A household earning $75,000 a year can only afford about 21% of the homes for sale right now. Before the pandemic in 2019, that same household could afford nearly half of all listings. The real pain shows up in the monthly payment. The annual cost to own a median priced home in the US now eats up a devastating portion of the median household income, surging past 40% by some measures. This is way beyond the 30% rule for what's considered affordable, and even tops the dangerous levels we saw right before the 2008 crash. You have to ask yourself, what kind of market is it if most of the people it's supposed to serve can't even participate in it? It's not a healthy market. It's not a strong market. It is, by definition, a broken market. And that's the silent crash. It's not a sudden drop in value, but the slow, agonizing death of access. The value is still there on paper, a number on a screen, but it's a phantom value, totally disconnected from the economic reality of everyday people. The crash is the sound of a door slamming shut on an entire generation of aspiring homeowners. This crisis didn't just pop up overnight, it was built piece by a series of decisions made over the last 2 decades. Each one made sense at the time, but together they created a perfect storm of unaffordability. To understand why this is a slow burn, you have to go back to the ashes of the last crash. The story really begins after the 2008 financial crisis. In the aftermath of that spectacular collapse, the Federal Reserve did the only thing it could to stop a full blown depression. They slashed interest rates to near zero. The goal was to make money cheap, to get people and businesses borrowing and spending again, and to breathe life back into a shattered economy. For more than a decade, we lived in an era of historically artificially low interest rates. Mortgage rates dropped to levels we'd never seen, falling below 3% at their lowest point. This cheap money was the medicine the economy needed, but it had a powerful side effect. It changed how we think about our homes. A house stopped being just a place to live and was supercharged into the primary investment for building wealth. With savings accounts paying nothing, the new mantra became, your house is your best asset. Real estate felt like the surest bet, and with mortgages so cheap, it felt like a game you couldn't lose. This shift was subtle but profound. It turned housing from a roof over your head into a speculative commodity, and for the decade between 2010 and 2020, the system seemed to work. Home prices rose steadily. Homeowners watched their net worth grow on paper. But what was really happening was that the foundation for today's affordability crisis was being laid. Each year of low rates allowed prices to climb just a little bit further beyond what wages could naturally support. We were stretching a rubber band year after year, and it was getting thinner and thinner. Then 2020 happened. The pandemic threw a gallon of gasoline on this simmering fire. The response was a perfect storm. First, another massive wave of stimulus. Interest rates stayed at rock bottom. Second, the work from home revolution completely changed housing demand. Suddenly, people didn't just want a home. They needed an office, a gym, and a school, all in one. Demand for more space, especially single family homes, exploded. This huge surge in demand ran head on into a pandemic induced supply shock. Supply chains for building materials were a mess. Construction projects ground to a halt. And many would be sellers, worried about the economy, decided to stay put. Massive demand, crippled supply. The result was a bidding war frenzy that sent prices into orbit. In just a few years after the pandemic, US home values surged by an astonishing 45%, packing more than a decade of normal appreciation into a couple of years. But this time, there was a new player in the game: institutional investors. Wall Street backed firms with billions in capital saw an opportunity. They started buying up huge numbers of single family homes, often paying in cash and easily outbidding regular families. Their goal wasn't to find a place to live, it was to turn these houses into a giant portfolio of rental properties. They aren't looking for a home, they are acquiring an asset class. This isn't just an American problem, it's a global one. In countries from Canada and Australia to the UK, home prices have dramatically outrun income growth. Some economists argue the real cause isn't just a supply shortage, but decades of reckless mortgage lending that flooded the world with cheap money, fueling a speculative mania. Housing became a global asset, and in the process, its main job, as shelter, was dangerously forgotten. So when you piece it all together, you see the slow burn. A decade of low rates priming the pump, a pandemic that created a demand shock, and the arrival of large-scale investors competing with families. Each step pushed prices further from reality, leading us to right now, a market that's technically at all-time highs, but is, in reality, silently and catastrophically broken. So, if the crash isn't a 2008 style price collapse, what does it look like? It looks like the data we're seeing right now in late 2025. The evidence is everywhere, but it's hidden in numbers that don't make for splashy headlines. This silent crash is a crash in sales, a crash in access, and a crash in hope. It's a market that is seized up. The first and most damning piece of evidence is the number of sales. Home sales have plunged to their lowest level in decades. Let's be clear, this isn't a minor dip. This is a market that has effectively frozen. A healthy market needs a constant flow of buyers and sellers. A market with historically low sales is a sick market. It's a giant warning sign that the price is wrong. Asking prices are at a level almost no one can afford, and sellers can't or won't lower them. This brings us to the lock-in effect. The vast majority of current homeowners are sitting on mortgages with laughably low interest rates compared to today's rates, which are hovering in the mid 6% range. In fact, over 80% of borrowers have a rate far below what you can get today. Think about what that means. Imagine you bought a home in 2021 with a 3% mortgage. Now, your family has grown and you need more space. In a normal market, you'd sell and move. But today, that's financially crippling. If you sell, you give up your golden handcuff mortgage. To buy a home of the exact same value, your monthly payment would skyrocket. A borrower taking out a $300,000 loan today would pay nearly $600 more every single month than someone who borrowed the same amount just a few years ago. So people are staying put. They're trapped. This isn't a stable market, it's a stagnant one. And this lock in effect is choking off housing supply, which is one of the only things propping up prices. It creates a false sense of scarcity, so the few homes that do hit the market can still get high prices, masking the fact that there's no broad demand. But even with that, the cracks are starting to show. In many areas, inventory is beginning to pile up. Nationally, the number of homes for sale is up over 17% compared to last year. And when inventory rises, price cuts follow. In September 2025, nearly 1 in 5 homes on the market had its price dropped. This is the market desperately trying to find a price where people can actually buy. And while some tight markets are still seeing prices inch up, the pace is slowing dramatically. And if you think that's bad, look at what this has done to the 44 million American households who rent. For every person priced out of buying, another is forced to stay in the rental market, driving up competition. This is a huge reason why rents today are still 35.1% higher than they were before the pandemic. The rental numbers are just as scary. Nearly half of all renters in the US are now cost burdened, meaning they spend over 30% of their income on rent. Even worse, a record 12.1 million renter households are severely cost burdened, spending more than half their income just on housing. This isn't just a problem for the lowest earners anymore. For renters making between $45,000 and $75,000 a year, the rate of being cost burdened has more than doubled. When you're spending half your income just to keep a roof over your head, you're not saving for a down payment. You're not investing for retirement. You're one car repair away from financial disaster. This is the other side of the silent crash. A rental crisis that is destroying the financial security of tens of millions and making the dream of homeownership a fantasy. So, what does this all mean for you? It means the game has totally changed and the old rules are broken. We're going to break down how to navigate this new reality in a moment. But first, if this is making sense to you and you want to keep getting the real story behind the headlines, take a second to subscribe and hit that notification bell. We put out deep dives like this every week to help you understand the forces shaping your financial future. So the big question is, when should I buy? Or should I wait for prices to crash? But we've already established the crash you're waiting for is happening now, just not how you thought it would. So the solution isn't trying to time the bottom of a 2008 style collapse that might never arrive. The real solution is to completely change your perspective. It's about letting go of the old dream and embracing a new, more pragmatic reality. It's about redefining what it means to win. For generations, the rules were simple: buy as soon as you can, get the biggest house you can afford, and watch your investment grow. That playbook is now officially obsolete. The new rules demand a level of financial discipline and local market knowledge that was never required before. The first new rule is stop watching the national news and become a hyper-local expert. The US housing market is a myth. We're in an era of intense fragmentation. Some markets in the Northeast and Midwest might hold their value, but others, especially in Sunbelt cities that saw insane pandemic price hikes, are showing much more weakness. You need to dig into the data for your specific city, your specific neighborhood. Look at the numbers that matter. How many months of supply are on the market? Is that number going up or down? What percentage of homes are getting price cuts? How long are homes sitting before they sell? That will tell you the real story. The second new rule is to redefine what winning looks like. For decades, winning meant owning a home. Period. Today, winning means having financial stability and flexibility, whether you rent or own. Being house poor in this environment is a trap. It might be a far smarter financial move to keep renting and invest the thousands of dollars you'd be spending on a mortgage, taxes, and maintenance. Rushing into a home you can barely afford isn't a victory. It's a financial prison. Winning might mean accepting a smaller home. It might mean a condo instead of a single family house. It might mean moving to a more affordable city. The dream of a big suburban house is no longer a realistic goal for a huge part of the population. The new dream is financial freedom. Make your housing decisions to serve that goal, not some outdated cultural script. The third and most important rule: make your own finances bulletproof. The only thing you can control is your own balance sheet. That means aggressively paying down high interest debt like credit cards. It means building an emergency fund that can cover 6 to 12 months of expenses. It means getting your credit score as high as possible. A strong financial position gives you options. It lets you weather downturns, act when a real opportunity comes along, and walk away from a bad deal. Trying to time the market is a fool's game. Preparing yourself is the only strategy that actually works. Ultimately, the deepest problems here require big policy solutions. We need to build way more housing, especially affordable and missing middle types. We need to reform zoning laws that drive up prices. But those are generational challenges. For us, right here and now, the solution is awareness. It's understanding that the market is broken, knowing why it's broken, and making clear eyed decisions based on that knowledge, not on nostalgia for a market that doesn't exist anymore. The silent housing crash is not some future event to be scared of. It's what's happening right now. It's a crash of affordability, a crash of sales, and a crash of the link between a hard day's work and a roof over your head. Those record high home prices you see in the news aren't a sign of a healthy market, they're the tombstone of one. They represent the absurd final stage of a system that prioritized housing as a speculative asset over its essential role as a human need. We are living in a frozen market. Millions are trapped by the golden handcuffs of their low mortgage rates, and millions more are trapped in an ever more expensive rental market. Sales volume is at a multi decade low because the price is simply wrong for the vast majority of Americans. This isn't a temporary blip, it's the new reality. The dream of homeownership isn't dead, but it has been forced to change. It's smaller, it's harder, and it requires a level of financial savvy and sacrifice that past generations could scarcely have imagined. Admitting this painful truth is the first step. We have to stop waiting for a bubble to pop and start dealing with the slow, grinding crisis that is already here. The real question isn't when will prices fall? It's what does a healthy and fair housing market even look like? And how do we start building it? What does the housing market look like where you live? Are you seeing inventory pile up, price cuts, or are prices still climbing? Share your story in the comments below. Let's talk about what's really happening on the ground.